Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Slack stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Slack is a software company founded in 2009 in Canada. It is a channel-based messaging platform. With Slack, people can work together more effectively, connect all their software tools and services, and find information they need, all within a secure environment. The basic explanation of Slack is it replaces the use of email inside of an organization. It is not used for one specific purpose, but for everything people need to do together at work. Slack can be used for job review candidates, to coordinate election coverage, diagnose network problems, negotiate budgets, plan marketing campaigns, approve menus, along with countless other tasks. In June 2019, Slack IPO'd on the New York Stock Exchange. Let's get started with the model. This is a large cap company, 23.2 billion market cap. They're trading at $41 a share, and they have 557 million shares outstanding. Let's look at the financials. The way you value a company, you estimate the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And they have negative free cash flow each year, but it's getting pretty close to break even. They had negative $8 million in trailing 12 months. Net income is a profit and loss on the income statement. It's revenue minus expenses. And they have negative net income every year. Revenue looks really good. It almost doubles from 2018 to 2019, then goes up 36% to 2020, then goes up another 18% in the trailing 12 months. So they're growing at a pretty rapid pace. This is the company's income statement. The top line is the revenue. Below that is the cost of revenue. The difference between those two numbers is the gross profit. So you can see they have a pretty healthy gross profit every year, but the operating expenses are so high, so they have negative operating income every year. So the result is negative net income every year. But you don't get all the information from the income statement. You have to look at a statement of cash flows to get a full picture of the company's financials. This is the statement of cash flows, and operating cash flow is a better indicator of a company's financial health for that particular year than net income. Over many years, if you compared operating cash flow and net income, it should be fairly similar. But for a given time period, operating cash flow is a better indicator of a company's health because operating cash flow takes net income, then it adds back the non-cash items from the income statement. And to calculate free cash flow, it's operating cash flow, which is on top, minus capital expenditures. So that's why they have negative free cash flow every year, because they have a lot of CapEx. Plus, they do have negative operating cash flow every year, except in the trailing 12 months, they actually had a positive. So things are looking up. So you can see in the trailing 12 months, they had negative $324 million of net income, but they have positive operating cash flow because the company paid $248 million in stock-based compensation. This is an expense that brings down your net income on the income statement, but it's a non-cash item because cash doesn't leave the company, it's stock from the company. So when you calculate operating cash flow, you have to add back the $248 million. So you can see in the trailing 12 months, the company had $24 million of operating cash flow. This is what you want when you invest in a business, to have operating cash flow so they can use that money to run the business and grow it and pay you, the investor. So if a company has negative operating cash flow year after year, it needs money from somewhere to run a business. That's either through debt or equity. This company hasn't used much debt financing. It's mainly used equity financing, issuance of common or preferred stock. In 2018, it issued a little over $400 million in capital stock, and then in 2019, also a little over $400 million. Let's look at a capital structure. $227 million of debt, $709 million of equity. And their weighted average cost of capital is 10.5%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $12.2 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $8.9 billion. We divide that by 557 million shares. And we get a calculated stock price of $16. They're trading at $41, so they're trading at a 155% premium. It's a sell according to the model. Simply Wall Street is almost identical to my valuation. They're at $15.99. I'm usually not this close to Simply Wall Street. Simply Wall Street gets its valuation based off of the average analyst estimate. So when you value a company that has negative free cash flow each year, you can't expect them to continuously have negative free cash flow because that means the stock price will become negative. Investors are forward-looking. Although you do look at the past to try to figure out the future, you don't expect the future to look exactly like the past. So obviously investors feel comfortable paying $41 a share for this stock because if they didn't, the stock price would get pushed lower. And if they felt the stock price should be a lot higher, they will push the price higher and higher until equilibrium is met. It's based off of supply and demand of the market. Some people are buying the stock now for a quick flip. They hope the stock will go up to $45 or $50 and they'll sell it. Other people think the stock is a great long-term play, but everybody has their different investing strategy. My strategy is to hold long-term. So you can see the stock has been pretty steady since its IPO. It did drop a lot, but it came back up. According to the company's 10K, they've never paid a dividend, and they don't plan on paying dividends in the future because they need to retain the money to grow the business. And if you invested $10,000 when this company IPO'd a little over a year ago, you'd have $7,700 today. That's a 23% loss. Here are some high-level stats from their 10K. The number of paid customers grew from 59,000 to 88,000 to 110,000. And the number of paying customers who pay over $100,000 a year went from 298 to 575 to 893. So Slack has 660,000 companies that are using its platform. 550,000 used a free platform, 110,000 used a paying platform. Some companies have thousands of employees using Slack. Other companies have hundreds of thousands of employees using Slack. And they're really diversified. There wasn't any company that had more than 3% of the company's revenue. So if any of those companies go bankrupt or stop using Slack, it really won't affect their business too much. In 1 year, Slack users sent 1.4 billion messages. And half of their business comes from the customers who pay $100,000 or more a year for their service. And almost all their revenue comes from subscriptions from their service. And customers either pay monthly or annually for Slack. Let's look at the financial ratios. The average PE in the market is 14.2, the median is 14.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. The average price of sales is 6.0. The median is 2.2. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. So they're a lot higher than the median and average. A big thing I like about the price to sales ratio is it can never be negative because sales can't be negative. It can be zero, but not negative. The average price to book is 4.7. The median price to book is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 32.0, so they're a lot higher than the median and average. You generally want a lower price to earnings, price to sales, and price to book ratio. Equity is assets minus liabilities on a company's balance sheet. They don't have any interest payments on their debt. The average ROE is 11%, the median is 12%. ROE is net income over equity. They have negative net income, so they have a negative ROE. The average current ratio is 1.9, the median is 1.3. Current ratio is current assets over current liabilities. They're at 1.9, so they can cover their current liabilities with their current assets. And their current assets are $770 million of cash, $145 million of receivables, and $56 million of prepaid assets. So their trailing 12 months free cash flows was negative $8 million. So it looks like they're doing well. They have more than enough cash on their balance sheet to run the business. Plus, if they start turning a profit, they won't need to use the cash on their balance sheet. They can use the cash from their operating business, which is the ideal situation. The best way to look at ratios to compare them to similar companies, I've done videos on Autodesk, Atos Software, Salesforce, Citrix, Docebo, Datadog, Ideanomics, Intuit, Kinaxis, MyTech Systems, Mogo, Nemcheck, ServiceNow, Real Matters, Texas, The Trade Desk, and Uber, all in the same industry as Slack. And if Slack has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they're negative. Their price to sales and price to book are higher than average. They have a good current ratio. It is below the average, but 1.9 is fine. Negative ROE. Their debt is a little lower than average. They don't use much debt to finance their business. It's mainly equity. And they have a market cap of $23 billion. Average is $35 billion. And they don't pay a dividend. Most companies in this industry do not pay a dividend. So to summarize, I have them trading at a 155% premium. Their ratios look really bad compared to their peers, but their financials are coming along. Although they don't look so great now, it seems like they're getting to a point where they may become profitable. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation, just support the channel. You can become a member by clicking the link in the description below. Thanks for watching.